Hi everyone, Lauren Stamper here with Highlands Residential Mortgage. I'm a senior loan officer and I'm passionate about educating and empowering folks in the home purchase process. And today I have with me a special guest, Kent Lindloff with Real Property Management Legends. And he is somebody that I work with very closely with my investor clients. And Kent, if you don't mind just starting us off with an introduction about your background, your experience, and what Legends is all about.
Sure, Lauren. Thanks for having me. My name is Kent Lindloff. As she said, I am the broker owner of Real Property Management Legend. We've been in business for about 8 years, manage around 215 to 220 doors in the DFW area. We are focused on providing the most comprehensive white glove service we can to owners who are busy. They're professionals. They have family. They have a lot of social engagements, and they don't have the time to manage their own investment properties, but they want to diversify. They want to build that wealth. And that's where we come in. We take away that hassle while you sit there and collect passive income and generate real wealth through equity and other tax shelters.
Awesome. I'm so glad to have you here today. And obviously, we work very closely together. But the purpose of today's conversation is helping people understand that are either they have rental properties currently or they're thinking about procuring properties. What does it look like to utilize a property management company to manage those their doors? Is what you call them. So somebody looking to purchase their first rental and they're trying to keep costs down, obviously, because as is, mortgages are high due to the interest rate climate and property taxes in Texas are high. So what does that look like to self-manage versus leverage a company like yourself to manage it for them?
The biggest thing that's really important is understanding the legalities of being a landlord and what your responsibilities are to tenants and what a tenant's responsibility is to you. We've seen DIY landlords get themselves struggled with everything from not lining out their lease to cover basic things like pest control, and they found themselves on the hook for constantly providing pest control, even though it's the tenant's conditions that created it. Another important thing is understanding the market you're in. A lot of owners come back and go, well, Zillow said my rent is this. But understanding that depending on the area you purchased in, the variety of homes, the stages of rehab, renovation, that estimate is commonly not very accurate. Another thing is you don't actually see the days on market, and understanding that being a little below market value but renting faster will pay benefits and put money in your pocket in the long run. And a lot of owners just don't understand it. So big things: lease execution, understanding the market when you're actually putting them on there, and then screening your tenants. If you're not doing a proper, full, detailed screening of tenants, we catch tenants all the time that are trying to move before things show up on their records, or falsified income documents, or they just have bad credit. And a bad tenant will ruin your experience. So those are some of the key ones.
I can attest to that personally. Yeah, when I got into real estate investing, I self-managed as a way to save costs, because at the surface level, it sounds cheaper to self-manage than it does to hire a company to do it for you. That was not the case. It would have been substantially less expensive for my personal experience to have had it managed by a company from day one, as opposed to, eventually I got on the bandwagon and I used a property management company. It's been seamless since. But when I was self-managing, things came up that I was responsible for that I didn't know how to do. I probably overpaid because I didn't have a group of contractors I could work with. So it was very challenging. And then I had to evict. And for an individual to evict another individual is really messy. So I feel like it feels like it would be cheaper to self-manage, but in the end, the cost that you spend on property management is very minimal.
It is.
For all of the services that you cover. And you said something interesting to me that I think a lot of people overlook. And you were talking about things specific to what market they're investing in, which tells me that the best time for somebody to have a conversation with you about exploring property management is probably before they even purchase.
Absolutely. If you know you're If you know you are purchasing for an investment, it's very important to talk to a property manager, even if you just, if nothing else, to get an insight. Perfect example of what happened is about 3 years ago. Unfortunately, a owner brought us a lovely little a condo that they purchased for the purpose of investment. We did market research. We came out. We said you're going to be around $1,100 to $1,200 is sort of. It's a 1-bedroom condo, right near Midway and 635. And they said, well, my real estate agent said 1,300 to 1,400. I'm like, I don't know what. And he showed me the comps, and they were quick comps. What they missed out on, the comps, a lot of them were apartments. They were newer builds. They had pools and gyms. They had, I mean, and the one he bought didn't even have laundry facilities inside the unit.
Oh, wow.
So now you've got people who would normally be fine with it. We lost a lot of people because they didn't want to walk to the laundromat on site, or they didn't want to go around the corner to the laundromat or on the street. That's a significant impact. Those are some obsolescences that had an impact that the real estate agent was not familiar with, or would not have necessarily known. Looking at rentals and understanding that is very important. And that's where you can kind of get into a problem if you don't talk to a property manager first.
That's a great point. And your attention to detail, me having worked with you for so many years now, I know you and your whole team are insanely detailed to make sure that expectations are clearly set from day one, which sets our investors up to optimize their investment, which is the whole reason we're doing it.
Yes.
We're in a money-making business, and so your job is helping make sure that we're optimizing their investment by minimizing downtime, getting good tenants, and maintaining the property while the tenant is living there.
Absolutely. That is our number one goal. Keep it filled, keep it reasonable, and make sure you understand what we're getting into from the word go, because nobody wants to set expectations that are above, too high, and then have to come down to reality, because then you're starting out. I would rather overperform after setting realistic expectations than, oversell and then have to come back and go, well, we were wrong.
Yeah, absolutely. And I've known that to be the way that you handle your business with everybody.
Yeah.
So I know that you guys have a whole lot of tools and resources for investors to help them kind of figure out the numbers, the metrics piece, and how they can manage that and assess quarterly or annually, however they want to do so. Can you talk a little bit more about the tools and like specifically what types of metrics you guys are tracking to and how you help people assess as they're going what the performance of their investment is?
Yeah, absolutely. So we have a tool that's proprietary to our company, our Real Property Management, and it's called Wealth Optimizer. Cheesy name, but
hey, it's what we're trying to do.
It's what we're trying to do. So what it does is it will take all of your factual data. It will pull public records. We can import your repair costs, your initial outlay, right? Understanding what your ROI versus your ROE is.
What's ROE?
ROE is like return on equity versus ROI, which is return on investment. So understanding those two things, understanding what a gross rent multiplier is, and how that can be beneficial to you. A lot of times here, there's an old thumb rule of your rent should be 1% of the value of the home. That's not realistic here in the state of Texas, or at least in the DFW area.
Not anymore.
Not like it used to be. We haven't seen that. I saw that in Sherman in 2019, 2020, and even Sherman's not really there anymore. So you're really about 0.7 to 0.75, depending on the area. But this tool will help you track. We can tell you what your current investment is. We can show you how that home should be performed based on an average of about anywhere from 4 to 5% year over year equity build, how you're paying it down, show you where your growth is and what that return is going to look like in 5 years versus 10 years. And it'll even show you kind of if you sold right now and had equity in there and were to put that in a 401k and kind of you compared the performances, and it'll give you, now's a good time to sell, now's a bad time to sell. But if nothing else, so many people only see the cash flow and they go, oh, I'm writing a check for $50 every month. I'm losing money. It's like, well, you're not losing money in a negative cash flow. This helps visualize that even if you are paying out of pocket by a little bit of every single month, you are still gaining wealth. You are still paying down that mortgage. Somebody else is paying those taxes. Somebody else is paying that insurance, and you will continue to have a higher net worth year over year over year. Just like you put money into a 401k every single month, if you're putting a little bit of money into a investment property every single month, you will see those returns.
That is a great perspective, and something I want to highlight. Most people, when they're trying to decide if real estate investment is for them, they're wanting to see from day one positive cash flow month over month. But if we zoom out a little bit and look at annualized returns, it is very clear that almost always, year over year, it's positive because of home value appreciation, write-off strategy on your tax returns, and then, like you mentioned, principal pay down. So overall, annually, you do come out ahead. But if we're looking month to month and somebody's, investing as little as they can to get a property, it probably is going to be your rent is not going to cover the full mortgage payment in current market.
Current market, unless you're putting a substantial payment down.
And I wanted to talk to that because you had mentioned that you can expect around 70 to 75% of sales price for rent.
0.7.
Well, that's what I meant. I'm sorry.
Gotcha.
Yes, 0.7%. That equates right now to around a 30 to 35% down payment. And I think that's important for people to understand because they need to make the decision from a monthly budgeting perspective. Are you strapped and do we need to make sure that it is fully covered? Because if so, we need to be planning for a higher down payment. Or are you comfortable assessing your success on an annual level instead of a monthly level? Because then you can put minimum down and we'll be okay with depreciation and mortgage interest write-off and tax and insurance write-offs, repair write-offs, property management company write-offs. Exactly. It's a really good annual return, and we're not just doing this for the next 2 or 3 years. Like the goal when we're adding doors to our portfolio is long-term generational wealth.
Yeah. This should be 5, 10, 15 years sort of ideals in a perfect world.
Absolutely.
If you decide that you're in an area where you're struggling and you want to cash out, do a 1031 exchange and then go buy a property in a better, hotter market, sure, that makes sense depending on what's going on. But this is not a jump in for a year and a half, see how it works, and then sell it and get rid of it because you're going to wind up disappointed in your results. This is definitely a long game, and people understanding that is important.
Absolutely. So in terms of building people's team for investing in real estate, obviously, unless they're paying cash, they need somebody helping with the finance.
Sure.
A property manager to help them understand all of the things that you guys manage in terms of maintenance and tenant placement and tenant management and repairs between tenants, all of that stuff.
Absolutely.
Who else do you feel like is important from your chair for them to have as a team as they're planning investing in real estate?
The other people I would say is, you're going to need someone who understands insurance. Most property management companies, including myself, need to be listed as additional insured on your property. That costs on your landlord's policy. It costs nothing. It is not. It means nothing other than it's just a piece of paper that we're on there. It doesn't cost you anything. It shouldn't impact the value, the cost to you. It's just a standard acceptance. So we're both covered for that policy. In the unlikely event something happens where we're dealing with legalities or something like that.
That's a great tip.
Because a lot of times they don't realize that. So having a good insurance person first who can help you shop around, especially with the cost of insurance in Texas right now. A good CPA would be helpful to understand and maximize what your write-offs are. If you are in a positive cash flow, I mean, the secret, sauce, so to speak, you talked about all of the deductions and things. And yes, everything I do for everything you spend with us or with the vendor is 100% a write-off against that gross income. But the other one is the depreciation of the property. So if you are in a positive cash flow, there's a good chance, unless the house is completely paid off, that most of your actual net income can then be written off. So does tax-free income. And that's the magic button where it comes to real estate investment for a lot of people, because you can make $6,000 while in your pocket every year while showing a $3,000 or $4,000 loss on the property just due to depreciation. So a good CPA is important to know that. We already talked about the lender. Also, you need a sales agent. Some property management companies can provide that. We do not. We specifically focus on the residential property management side, but we do work with some amazing real estate agents that know and understand what makes a good investment property, and make sure that your agent understands this is investment property. So they're talking to the HOAs to make sure there's no caps and restrictions on it. We had somebody who bought a house, got stuck paying $500 a month for 9 months while he got cleared because he thought he had his rental registration approved because he bought a rental home. It cycled over because he bought the home, a new owner, new line, new.
Oh, wow.
So
that's a great point on the HOA, because some HOA communities do not allow you to buy property in their community as a rental home.
Or they have a really long period of time. My own HOA had just posted a 2-year home ownership requirement.
Oh.
That's to keep Blackstone and places like that from buying up properties left and right. So those are really important things, and you want an agent who will do the due diligence for you, or help you do those due diligent things to make sure they're right. And then they want somebody who understands what they look like. But that's where we can come in. If you're down to, top 3 homes, we'll run numbers for you. We'll help you look at it, and we'll say, we think this is the best, dollar for dollar value.
That is a huge value add. Okay. So I want to piggyback on something you said. Having a real estate agent help you identify the property you want to purchase as an investment is key. You want somebody who can assess a property for structural integrity, types of layouts that are most rentable, making sure that there are features on the home that most people want. Things like, when you can, an open concept, or having a room that can either play as a formal dining or a study, because a lot of people work from home now. Yep. So I think that having also like the 3-2 layout seems to be a very, very popular 3-2, 4-2.
4-2s, 3-2s with a dedicated study.
And a garage.
Garages are important. Fenced-in backyards are important. And it's also important to understand what else is in the neighborhood. Like in some neighborhoods, the older ones like Garland, garage conversions are pretty common. So they're okay. They're desirable. But if you had a garage conversion in, Frisco somewhere, wherever else that wouldn't be common. That would actually take away from the value of that home.
Interesting.
So another one, just a personal thing for me, is when you're buying a home, it's an investment home, you want to look at the durability of everything that's in there. If you're buying a home with carpet because it's cheap, I would budget to put in not hardwood, but a high quality LVP flooring. Don't go the cheap route. They wear out very quickly. I mean, a 5 mil, 6 mil layer LVP doesn't last any longer than carpet because it just can't take the beating from traffic, from kids and dogs and things like that. Tile's great. Granite countertops are great. Don't get marble or quartz or anything too fancy. Smart homes seem awesome, but smart homes are designed for homeowners. They are going to be a chronic pain to cycle between tenants and get them set up on the smart home versus the others.
Oh, interesting.
So those are things to think about when you're doing these. Is you want a simple, functional home that has durable finishes and has really good bones. If you do that from the beginning and buy like an investment instead of buying on emotion because you think those bay windows are so pretty, it will help you in the long run, and it will help keep your costs down in the long run, because you won't get immediately hit with expensive repairs. One of our mutual colleagues, Troy, had one like that. Made it a beautiful home, did a lot of things. We moved people in. He was going to sell it. We moved people in within 3 weeks. They discovered that there was a partially collapsed main drain. So after spending all the money to make it pretty, he then had to go outlay another, thousands of dollars to go fix that drain line.
Oof.
So that's where it's important to know those bones.
Yeah, definitely. So in terms of tenants, do you have many people doing 2-year leases, or is 1 year far and away still the most common?
1 year is still far and away the most common. We do have a few people that, we have discussed and negotiated 2-year leases with. Depending on the market. When the market was very strong, we would do it, but we'd always include a 1-year escalator. So it's $2,500 this year, it will automatically move to 25.50 for the second year. That way, they have a controlled market
Payment, they know what's
increase,
going to happen.
and the owners are protected from potentially falling too far behind.
Okay.
Obviously the market's changed; things are a little flatter now, so it's not as big of a deal. Owners still like a 2-year commitment. The thing it's important for an owner to think about is you're not just getting a 2-year commitment from them; you're committing to 2 years to the tenant. That means if you find out 6 months in this tenant is a challenge or high maintenance or this or that, or they consistently pay late or things like that, and you're stuck with them for 2 years. So we will always do it if that's what the owner wants. We'll always have the discussion first. We always recommend starting with a 1-year lease.
Okay.
And then, hey, if they're great, they love them, they're great tenants, you're a great landlord, everybody's happy, yeah, let's bring in a 2-year lease. And then we can lock them in because we know they've been performing well.
That makes sense. Okay. Because I would think just, off the cuff, a 2-year lease is great because the turnover between tenants is expensive. But to your point, date them before you marry them.
And the thing is this, when tenants are happy, they renew.
Yeah.
We have a very high retention rate. Most of our tenants are in place north of 2 years.
Oh, that's great.
So I would say we're running around 2 years, 4 months, whatever the average is.
Okay.
Because moving is expensive.
It is.
So,
and painful.
our goal, our desire is the tenants are moving out because they're relocating for work. They're moving out because they bought a home, or they're moving out because something has unfortunately happened, divorces, roommates split up, things like that, and they can no longer. Those 3 things are unavoidable. But if, so that's what we're looking for, So if we can keep it to that, then tenants will typically stay a long time. We just ran through another series of renewals, and the most recent ones were 2 years in, signing up for a 3rd year, so
great.
forth and so on. So we see a lot of that.
That's good.
So just because you don't get a 2-year lease does not mean you're going to have to pay a bunch of money in the first year.
Awesome. So in terms of tenants, how do you guys screen? Like if you could just do high level, not in the weeds, but how are you guys screening for good applicants to consider for an investor?
Well, the big things we look at from a high level, obviously we're going to look at the credit score. And then we dig into the credit score, we want to look for specific items. We try to be forgiving on the medical and stuff.
Right.
But anyway, then we look at their gross verifiable income. And when I say verifiable, we need to verify all of you. You can't just say, oh, yeah, I make $500 extra a month babysitting. Prove it.
Yeah.
Then we look at DTI, right? DTI is how much money do they have left after all their fixed bills, including the rent that they're applying for. They have left to make to spend on clothing and food and other stuff. We check their criminal background history. Our biggest focuses are going to be on violent crimes and any crime related to intent to distribute when it comes to drugs, obviously, and felonies are the focus. And recency bias is important as well.
Sure.
Yeah, we're not holding people to something they did when they were 20 and they're in their 40s now. And then the last one is landlord history, and this one's really important to be diligent with. That's where we see the most common things where people sort of fudge, and you're not. And some landlords will just say whatever you want to get rid of bad tenants. So it's
that's terrifying.
Sad. It is sad but true. So, but I like to think we're pretty good at catching them.
Oh, I would agree in general. Just the way you guys run your business is really impressive. Do you have any advice for people who have the itch? Like they've purchased an investment property, they like how it's going, they want to add more doors near term. Do you have any best practices or tips or things you've seen that have worked really well with your other investors that it's worth sharing with our audience?
I guess the first thing I would say is take stock of what is going well and what's not going well with your current property. Understand where you maybe made miscues and what can be done to replace them. Secondly, assuming the property is up and running, we're assuming somebody's in there, so they've got that. Just see what kind of funding is out there for you, and understanding what you can do to bring that over. I do understand a lot of times you need a longer term lease in place, so make sure that you've got that lease far enough out so when they bring it to somebody like you that you have that in there. But it really just depends on what their preferences is and what they're driving. Are they looking for cash flow? Are they just looking for equity build? Are they,
Mm-hmm.
is this a long-term thing we always want it to be a long-term thing because that's what
Right.
makes the most sense. But, everybody has kind of a different view on it. The professional BR&R people, they really need that $300 to $400 a month cash flow.
Mm-hmm.
Understanding if you're looking for a good deal, you want to go get that broken down home and fix it up. Is that something you're capable of doing? Don't
Right.
go buy one because you saw somebody do it on HGTV.
Biggest trap.
Your first turnkey is great. That does not mean you should immediately roll into doing a fix and flip or buy rehab.
Yeah.
And for everybody understands, it's buy, rehab, refi, rent, and then you do it all over. And it's repeat is that fourth R. And that's the goal, and that's how you build it. But you really have to know what you're doing. You have to that's where you get your power team. You need a GC or somebody else on your power team if you're going to get into that.
Yeah.
But it's a great way to add properties fairly quickly if you want to be aggressive. You just have to understand what you're doing, especially if you don't have a lot of money.
Yeah, definitely. One of my favorite methods I'm seeing some of my younger clients do who don't have kids yet, especially because it's just easiest, is planning to buy a primary home, live in it for 1 year, and then buy a new primary home, move, and rent out their old home.
That's a great one, too.
You can do that over and over and over. And in 5 years, you could have 5 doors if you stick to the plan. And the cool thing is, every time you're only putting 5% down to get in instead of buying a rental property as a rental property and putting 15 to 25% down.
Nope, that is a great one. The one thing you have to think about in that is obviously the cash flow situation. So as long as you're comfortable putting that 5% down and sitting on it for a year, then that can be 100%. That's a very good way.
Yes, and that's why planning all of that up front, if somebody's goal is to come up with multiple doors in their portfolio, we can be working at the beginning when they're planning their next primary purchase, whether it's their first purchase ever or second or third family home purchase. We can be looking ahead already and seeing what would that look like 5 years from now, and how much do you need to save on a monthly basis to be prepared for that next 5% down payment.
Oh yeah, no, 100%. So, that makes a lot of sense.
Now, you said something earlier that I want to go back to, or it triggered something in my head. There's a lot of new build that's coming up that is specifically meant to be rented out, and new builds that you don't have to buy as a primary home. Do you have any investors that have focused predominantly on procuring new construction homes for the purpose of rentals, and how is that performing versus pre-existing homes?
Yes, we've worked with several, and I will say it's to be blunt, it's been a mixed bag.
Okay.
The great news is you're buying a home that should mostly be completely problem-free for 5 years. Another great thing I think is, especially in our current market, I believe if you're putting money down, the builders are literally just helping you buy down to ridiculously low rates that you can't get in the open market. So there's a lot of benefits to that. The trick and the challenge is in the areas where this is happening, the areas are pretty saturated.
Okay.
So you need to understand, have realistic acceptance that you're going to be very competitive in your pricing because you're going to be competing a lot. The areas we see that mostly in is the Forney, Princeton, and it's a little bit less because it's sort of matured, but 380, the Aubrey, Providence, those areas, those were really big about 2 or 3 years ago, and we saw a lot of this. And now when you go out there, there is a lot of competition on market for these homes. But again, if you have the money and you want to buy a brand new home that you can budget around, because at least for the first 5 years, you should see minimal maintenance costs. That's a very positive thing to have, right?
Definitely.
You can buy a lot of older homes and you may have a ticking time bomb that you're going to have to initially go and repair. So new homes are great. And I would say if you've got the money, go do that. Just understand there's some financial implications and you're going to be in a much more competitive area. And you may have to ride out, market rents that are a little lower than you'd want for a while until those areas mature a little bit.
Sure. How much, as a general rule, because I'm sure it's different depending on each property, but how long are you telling your clients to expect to find a tenant to put in place? So if we list it today, are we looking at, expect around 30 days, 60 days, somewhere in the middle?
It's going to be very location dependent.
Okay.
Places like McKinney, Plano, Carrollton still tend to go in about 30 days. Places like Princeton, Forney, you're looking at 2 to 3 months.
Okay.
Depending on, again, it depends on what your willingness is to make an adjustment. We never want to advocate giving a property away, but in this market, in the current economic scenario, sometimes you just have to go, you know what? I'll take a little less for a year, get them in, then we can cycle through, keep them in for 2 or 3 years, bring the rent up, wait for the market to change.
Right.
Because vacancy is expensive and everybody worries about, well, I don't want to give my house away for this much less. Well, right now you're paying that mortgage every month, so you're losing even more. And 1 or 2 extra months of vacancy where you're paying that mortgage is a lot more than getting $100 or $150 less in rent and having it rented out those 2 months.
Totally
So
agree.
it's very important. And I always tell everybody your goal is how much money can you get within the first year from the time you put it on market? And that means not waiting 2 months and only getting 10 months in a year. I know the leases are still here, but I'm just saying,
Right.
how fast can you get people in to start cash flowing it?
Sure.
Because you will offset that. So to your point, new builds can be very beneficial. Just understand that you are definitely in it for the long haul.
Got it. That makes sense. Okay. Well, that was a ton of super insightful information for our current and future investors. Is there anything that I could add to the conversation that would be helpful in this as well?
One of the things that a lot of owners talk about when they think about it, and I always put them in touch with you anyway, is understanding the financing is, there's a concern with financing in this area. And can you talk about, I think you mentioned like DSCR and some other things. Can you talk about some of those in detail, or if not, to kind of explain how owners that are looking to get that second, third, fourth home, but aren't going to do aren't looking to make residences out of them first? What other options are there?
So the cheapest cost of money, because at the end of the day, we're in this to make money. So your cheapest financing is traditional Fannie Mae conventional financing. So if people fit in that box, it's their best bet for sure. But a lot of folks, whether they're self-employed or they don't make tons of money on paper for whatever reason, we can still get people into real estate investing using, we call it non-QM loans. So you mentioned DSCR. That stands for debt service coverage ratio, which is a bunch of fancy words for, does the rent cover the mortgage?
Gotcha.
And in this instance, we're not even looking at the borrower's income. We're just looking at how the rent performs versus what the mortgage payment is. Down payments are pretty comparable to traditional financing. However, for first-time investors, we have to have a perfect 1-to-1 ratio. The rent has to fully cover the mortgage or it's not going to work.
Gotcha.
And like we talked about earlier, that typically means in this market, they're going to be putting 30 to 35% down. So they need to be prepared for that. So on these DSCR loans, we are looking at credit score, reserves, and rent. And that rent figure comes from the appraisal. So most people think of an appraisal as just determining the market value of the property, but we order a rent schedule in the appraisal so that we look at the value of the property and what other similar properties are renting out for. So we're looking at an average rent and price.
Okay. No, that's really good. That's interesting.
And what's nice is because there's no DTI, you can, or debt to income ratio being taken into account, you can add really unlimited doors this way if you've got cash.
Gotcha. Now, you said unlimited doors, but isn't there a cap on how many loans an individual can have?
If we're using Fannie Mae financing, yes, because that's yep. So with Fannie Mae financing, you can have 10 financed properties at a time. When we get to 10, if somebody wants to add more, we either can pay off a smaller loan using a cash out refinance or just paying cash for it, depending on what the loan size is. Or you can bundle those properties you have and put them into a commercial loan and start over on your 10 personal loans again. So there's different mechanisms when you get to that size. I feel like the majority of people don't have quite that big of aspirations. I feel like 10 is very forgiving and it's a lot. And when we talk about even just the reserves required, it becomes like when you get up into that 7 to 10 bucket, the reserves is hefty that you need to show. So, but just getting people a few doors, I think that they would be surprised. The people that actually ask to plan, they want to see what it looks like on paper, and they see that annualized figure. It feels so attainable. I think that a lot of people get stopped short. They have a mental hurdle with the monthly cash flow piece, and it's so short-sighted, but they can't see that themselves. They have to engage people that do this for a living, that have the right tools, like you, like myself, like Azeb in the tax strategy piece, to see, okay, when I'm taking into account the rent I'm making, plus all of the tax write-offs, plus house value appreciation, what actually is my equity position at the end of a year, and how much did I actually make after I deducted all my expenses I got to write off?
It can be significant for sure, especially especially in a good market. And you've already said that interest rates are dropping, which means as interest rates dropping, that flatlining of values that we've seen is going to start etching back up again.
Exactly.
So getting in now, as you like to say,
fruitful.
marry the property, date the rate. You can always refinance in a year or two once those rates come back down to earth, so to speak.
100%. Because when we have house value appreciation swings, and our most recent example was the COVID years, 2020 and 2021, we had house value appreciation over 20%. 2 years in a row.
Yeah.
So like compounded. And you either benefited from that or you were victim to that.
Yes.
So as in interest rates and house value appreciation, they follow a very interesting cycle. As rates go down, house values go up, competition goes up. When rates go up, house values stay flat or go down a little, and competition goes down. So right now, people are getting screaming deals on properties, new construction and pre-existing properties alike. Sellers need to sell. So if I've got strategic people listening into this, which I hope I do, they should really be considering making a move now so that they can benefit from, not be a victim of, the next wave of house value appreciation.
100% agree.
Because I think conservatively in our area, we see 3 to 5% appreciation year over year. And that adds up very quickly.
And that's exactly the model we use in the Wealth Optimizer. So you're seeing a realistic thing. We don't, obviously we don't, when the 10s, 20s and things happen, but
it's an outlier.
If you just have a realistic expectation of 3 to 5%, and then understanding that if you're not cash flowing in your first year, typically by your 5th year, you're going to start seeing positive cash flow, depending on how much you put down. And then by your 10th, 15th year, that cash flow really is going to go up.
Totally.
So then you get that return as well.
Yeah.
So I think the bottom line is it's time for everybody who's ready to jump in and see what happens.
I couldn't agree more. Do you have anything else you want to cover before we wrap up?
Sure. One other thing I do know is risk and reserve. So obviously we tell owners from a maintenance standpoint that you should assume about 1.5 months rent and on average in maintenance costs every year for, newer homes you can get away with, but, just on an average. And that doesn't mean you're going to spend every year. Sometimes that means years 2, 3, and 4, or 1, 2, and 3 are added up, and that's $4,500 or $5,000, and that's your new HVAC system or something very expensive, big ticket. But from a lending standpoint, you talked about reserves. What's that number look like for just your initial purchase? Is it 3 months or 6 months or?
It's weird how Fannie Mae does it. They do a percentage of the loan balance. Like if you own less than 4 properties, you're looking at 2% of all the combined balances of whatever homes you own. And it ends up being minimal, like 3-ish months. I recommend clients having 6 months reserves because I feel like that's a very comfortable safety net. And I also recommend them having their own bank account just for managing this, like all the income going into that one account, paying expenses out of that. That way it's segregated for if you want to look back and you're really trying to get in the weeds on your ROI or for bookkeeping purposes, for taxes. It really helps just have everything separate, and honestly to a credit card that's specific just to the management of your properties, especially if you're going to do more than one. It makes the management easier if it's separated. But I think that comfortably 6 months gives you plenty of room for if you've got vacancy, the repairs, just little maintenance things, and then the occasional big ticket item like you mentioned, if there's any structural repairs that need to be done or HVAC goes out or plumbing has an issue, you've got money sitting there that you're comfortable tapping into.
No, I think that's great.
Yeah.
I like it.
for DSCR loans, the standard minimum would be 6 months reserves, and in some instances, depending on the risk profile, it could go up to 12 months reserves needed.
When they look at those reserves, they're talking about the mortgage plus utilities? Do they add each
Just the mortgage
basic
payment.
mortgage?
So, and when I say mortgage payment, they include taxes, insurance, and if HOA is on
Sure.
the property,
Okay.
all of that together.
Gotcha.
Yes.
So pity with an H.
Pisha.
Pisha. We'll have to make up a new one. We'll have to make up a new one for that one.
Yes, awesome. Anything else, or you feel like that covers it?
Well, we talked about the scaling of the portfolio.
Mm-hmm.
Did you have anything else you added? I mean, your strategy is actually one that I've seen people do a lot, where they buy a home, move, and buy a home and move, and buy a home and move. And I think to your point, that's the best one.
I think one other strategy, if people are trying to add multiple doors that a lot of people don't think about naturally, is buying duplexes or quadplexes. So you buy one property that has 2 doors on it or 4 doors on it. I think that that's also something, in terms of ease of maintenance, everything being on one building is nice. And having one owner of that one building is also nice. So you can get traditional Fannie Mae financing for those types of properties.
Because you're living there.
No, if you want to buy it as an investment property, you can buy a 4-door property, up to a 4-door property. If you're living in one of the units, you can buy it as a primary residence.
That's what I meant. I'm sorry.
Yeah.
Because you're going to live in one of the multi-families, you can buy it as a primary residence.
Which is crazy because you get better terms and way lower cash out of pocket. So young folks that are interested in becoming real estate investors, that's a great trick to do so.
100%. No, we've got one that they tried to buy it. The owner wanted to sell a duplex, but the lease was too long. They didn't want to wait 6 months to move in to do a notice of non-renewal with one of the tenants.
I see.
So they passed on it. But I think that kind of covers all the stuff that I have. Did you have anything else or anything you want to talk about?
I think that's good. Thank you for your time. This
Absolutely.
is super helpful and interesting to talk about. And just for the audience, if you have any questions or you want to learn more about property management, definitely Kent is a phenomenal resource. His team is the best in the business. I trust him implicitly with my investor clients, and he gets nothing but rave reviews. So as you can see, he's incredibly detailed, very thorough, and his whole job is to optimize your investment, and there's nobody that does it better. So thank you so much, Kent. It was nice talking to you.
Appreciate it. Nice talking to you.